Thank you so much for attending my PowerPoint presentation on every lie Wall Street bets traders tell themselves. People will lose their entire life savings and then keep bag holding so they can meme about having diamond hands. In the world of WSB, some trades are minor setbacks, others are catastrophic life-altering disasters. In today's video, we are going to go over the exact cognitive traps that convince retail traders to actively destroy their own bank accounts. Massive losses, absolute ruin, total financial devastation. Go to any retail trading forum and you will see a bizarre ritual. Thousands of users actively celebrating the complete destruction of their bank accounts. In this self-described degenerate culture, sharing screenshots of absolute life-altering financial ruin is apparently just how you farm internet points and cope. It is a rite of passage. They turn tragic, irreversible financial choices into memes, just to soften the blow of terrible decisions. But let's look past the humor. Sharing these catastrophic losses serves as an unhealthy psychological coping mechanism that completely desensitizes traders to real-world consequences. This is not harmless comedy. When you treat financial ruin as a joke, you find comfort in shared misery. It normalizes destructive behaviors under the guise of communal validation. Instead of learning from a disaster, you get celebrated for it. It turns a warning sign into a badge of honor. You are not correcting your mistakes. You are feeding them to the crowd for applause. It makes the path to bankruptcy look like a comedy show. Once you learn to laugh off those initial losses, you need a logical rule to justify keeping those dead positions on your screen. Refusing to sell, denying reality, ignoring the balance. Mechanically, holding on to assets as they depreciate in value doesn't register as a realized tax loss until the position is officially closed out. That is the legal rule. But retail traders take this administrative reality and warp it into a core investment philosophy. They look at a stock down 95% and tell themselves that because they haven't clicked the sell button, they haven't actually lost a single dime. It is a massive coping mechanism. Refusing to close a failing trade to avoid realizing a loss is a fundamental misunderstanding of portfolio value. Your account is worth what you can sell it for right now, not what you paid for it 3 months ago. Hiding the damage does not protect your capital. Holding depreciating assets indefinitely avoids a tax-deductible realized loss while keeping precious capital permanently locked up in unrecoverable positions. You are left staring at a dead portfolio with zero purchasing power, all because you refuse to admit the money is already gone. But simply waiting out a falling stock isn't enough. The community has turned stubborn, holding into a badge of heroic identity. Some investors cut their losses early when a trade goes south. They accept the hit, protect their capital, and move on. But in the meme stock ecosystem, those players are ridiculed as pathetic paper hands. Instead, they're celebrating the traders who stubbornly hold through the absolute worst of it as heroes with diamond hands. They tweet gem and raised hands emojis alongside screenshots of their massive losses to signal their commitment. The unwritten screenshot equals cash out rule exposes that traders who boast about massive unrealized gains often lose everything because they refuse to take profits. This stubbornness is hailed as heroism, but it usually guarantees ruin. We saw this play out during the GameStop buying frenzy, which eventually became the subject of the documentary Diamond Hands: The Legend of Wall Street Bets. In the end, this mindset backfires. It encourages you to hold on to losing investments that have a near zero chance of ever recovering. When holding on to these tanking assets inevitably leads to disaster, the blame has to be shifted onto an external enemy. A rigged game, a corrupt system, a shadow conspiracy. Let's be honest. Blaming systemic bias for your trading losses ignores the reality that retail traders willingly play a high-probability losing game. Using the sarcastic excuse of a rigged market masks the fact that institutional players hold massive legal advantages in latency, liquidity, and order flow. Yes, hedge funds and market makers have superior liquidity, immense purchasing power, and real-time access to order books. They can even change the rules of the game when things go wrong, which we saw when brokerages restricted buying. But knowing this and still playing high-stakes speculative games is entirely on you. Using the rigged market excuse is a shield. It lets you express frustration and dark humor immediately after a loss without admitting you made a bad bet. Some market commentators believe the stock market is fundamentally rigged. Others argue that long-term investors shouldn't care because it doesn't affect long-term outcomes. But if you are day trading volatile options, you are stepping into a casino where the house has a massive edge and then complaining that the house won. If you're enjoying this breakdown of trading psychology, a subscribe really helps the channel. I'm trying to grow this community, and your support gets us there. It is much easier to stomach the loss of your life savings if you believe you are a soldier fighting a holy financial war. During the GameStop short squeeze, retail investors rallied behind community figures who placed massive bets against Wall Street. When brokerages restricted the trading of meme stocks, the community immediately claimed it was an illegal attempt to protect hedge funds, solidifying the narrative of an active war. Academic and media commentators even characterize this behavior as poetic terrorism and creative subversion, anarchist organizing designed to disrupt established financial power structures. But let's look at the reality. Viewing speculative market gambling as a moral crusade against Wall Street is a self-destructive illusion. Believing that meme stock buying is a populist economic uprising ignores the reality that institutional capital routinely exploits retail mania for arbitrage. You are not a revolutionary saving the system. You are just exit liquidity for the very institutions you claim to hate. To sustain the fantasy of an institutional war, the community had to invent entirely fictional trading tactics used by their enemies. Financial analysts and researchers state that the entire idea of a short ladder attack is complete, fabricated nonsense. Yet, if you spend 5 minutes on social media during a short squeeze, you will see thousands of retail investors claiming they are victims of this highly coordinated market manipulation. Proponents of this theory argue that hedge funds sacrifice their own shares by trading them back and forth at increasingly lower bid prices to trick everyone else into selling. But market experts are blunt. Prominent short sellers and analysts dismiss short ladder attacks as a completely fabricated conspiracy theory that is technically impossible under modern market clearing structures. Carson Block characterized the concept of a short ladder attack as a false conspiracy theory about short sellers controlling the market. Jim Chanos dismissed it entirely as complete gibberish, while Andrew Left called the theory flat out stupid. Inventing these fictional market manipulation mechanisms simply helps retail traders rationalize unexpected downward movements. They would rather believe in a shadow conspiracy than accept that the price is falling because people are selling. Let's pivot from systemic excuses to the toxic math of small accounts, compounding interest, safe growth, diversified index funds. The retail trading community actively discourages safe investing for small accounts, often labeling conservative investors with derogatory terms while praising high-risk gambling. If you have limited capital, you are told that slow, steady growth is a waste of time. You rationalize reckless behavior because you feel you have nothing of significance to lose. You look down on balanced portfolios, choosing instead to chase high-reward options and volatile meme stocks. You use stimulus funds or small personal savings to chase massive payouts rather than building a diversified foundation. But believing that limited capital justifies reckless risk-taking ensures that small accounts never have the chance to grow. By treating small accounts or stimulus checks as casino chips, retail traders bypass the power of safe compounding and guarantee rapid account wipeout. You throw away the mathematical advantage of time, ensuring you stay broke. This desperate search for explosive growth naturally funnels traders into the ultimate gambler's fallacy. Keith Gill became a legend by placing massive bets on GameStop shares and call options, turning a modest sum into a fortune. Fixating on rare success stories like Keith Gill leads non-wealthy traders to ignore the overwhelming mathematical likelihood of complete portfolio destruction. This lottery ticket mentality is especially appealing to younger, non-rich individuals who feel completely locked out of traditional avenues of wealth accumulation. They view high-stakes market gambling as their only realistic escape route. They engage in YOLO trades, dumping their entire portfolios into single, highly speculative options. The community celebrates the rare, massive winners while completely ignoring the vast majority of traders who lose everything. Chasing a single legendary payout causes traders to repeatedly take extreme risks that lead to total capital depletion. If you are convinced you only need one big hit, you will inevitably hunt for the cheapest lottery tickets on the options chain. Mechanically, out-of-the-money options are contracts that have low entry costs and lower premiums because they currently possess no intrinsic value. They are significantly less expensive than in-the-money or at-the-money call options for the same underlying stock. But looking at these low prices as a discount is a massive delusion. Low premium prices on deeply out-of-the-money contracts are a reflection of their near-zero probability of success, not a bargain. Retail traders believe they are limiting upfront risk while chasing massive profits. In truth, these options are mathematically priced to reflect that they possess zero intrinsic value and carry a nearly 100% chance of expiring completely worthless. You are throwing money at contracts that are designed to decay to zero. When those cheap lottery tickets fail, traders escalate from gambling with their own money to borrowing from their brokers. Some traders accept their losses, lick their wounds, and wait for their next paycheck to rebuild. Others decide to borrow capital directly from their broker to amplify their purchasing power. They treat leverage with a complete lack of seriousness, viewing it as a simple tool to bypass capital restrictions and boost their YO low bet sizes. Joking about deleting a trading app to escape a margin call ignores the harsh legal reality of debt obligations and aggressive third-party collection. Using borrowed capital dramatically amplifies both potential gains and losses, exposing retail traders to sudden, unrecoverable forced liquidations. When the market moves against you on leverage, the broker doesn't wait for you to make a choice. They forcibly liquidate your positions at a loss, leaving you with nothing but a massive debt bill. Once that borrowed capital vanishes, a powerful cognitive trap kicks in to prevent you from walking away. The absolute worst promise you can make to yourself in trading is that you will quit as soon as you get back to even. This is a classic psychological trap rooted in loss aversion. Instead of cutting your losses and walking away, you continue to place increasingly risky bets to chase those losses. The community frequently documents stories of traders who refuse to walk away after initial losses, only to lose their entire life savings while desperately trying to recover their initial capital. Loss aversion locks traders into a cycle of doubling down on bad bets to recover past losses, worsening their financial state. Refusing to admit defeat drives traders to chase losses on highly volatile instruments, turning minor setbacks into absolute ruin. You keep digging the hole deeper, convinced that the next shovel full of dirt will somehow bring you back to the surface. This leads to the final, most dangerous stage of the retail trading delusion cycle. The community often highlights desperate posts from users who have leveraged their credit cards or personal loans to fund speculative trades. If you are facing the harsh economic realities of personal debt, you might mistakenly view the chaotic stock market as a viable escape hatch. You turn to high-risk market plays hoping for a rapid, massive payout to clear your liabilities. Using credit cards or personal loans to fund speculative market plays compounds existing liabilities, converting manageable debt into total financial collapse. Attempting to resolve personal debt liabilities through high-risk stock and options trading is a recipe for bankruptcy. It is a desperate spiral that turns manageable financial pressure into complete, irreversible ruin. You are trying to put out a fire by throwing gasoline on it. And that is the 12 lies we WSB traders fall for all the time. Thanks for watching and subscribe.